Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're discussing the latest edition of the UBS Reserve Manager Seminar. As 2025 unfolds, central bank officials around the world face a confluence of geopolitical, economic and structural challenges that are reshaping the investment landscape. The RMS and accompanying survey provide one of the most authoritative depictions of official RM activities available, including the views of around 40 central banks, covering geopolitics, currencies, asset allocation and more. Amongst the themes we'll discuss today will be stagflation, replacing soft landing as the dominant base case, the state of confidence in the US dollar and treasuries, the demand for gold, whether trade wars and political risks now outweigh recession concerns, and what the diversification story looks like across currencies, asset classes and regions. Today on the show, we're joined by two sovereign investment experts to make sense of all that. It's a pleasure to welcome back to the show Max Castelli, Head of Strategy and Advice, Global Sovereign Markets, UBS Asset Management. And alongside him, we welcome Shamaila, Head of Emerging Markets and Asia Pacific Fixed Income. Max, Shamaila, welcome. Now, Max, we've spoken for the last 3 or 4 years after the RMS, but this, of course, is a survey that's been happening for over 30 years. Remind us about that context. Tell us why the RMS is so important. And tell me some of the headlines from this year's edition, whether that's geopolitics, Trump 2.0, trade wars, etc.
For us, it's very important because every year allows us to really understand what central banks think about the economy, about the geopolitical environment, and as well about the management of their asset, so-called foreign exchange reserve. This year was quite an interesting time to carry out the survey because, of course, we had this major disruption, in particular Trump 2.0. And in fact, we dedicated a whole section of the seminar, a special section, asking a lot of questions about what are the implications of the policy of Trump. So let me start, first of all, from the economic and financial outlook. There was quite a striking increase in pessimism in the economic outlook, in the sense that the stagflation scenario is now considered by the respondent to the survey as likely as a soft landing scenario, something completely different from last year, where the soft landing was overwhelmingly the most voted scenario for the next 5 years. So there is definitely, let's say, central banks are worried that the geopolitical and political events will eventually have a negative effect on the economy. And of course, as you mentioned, global geopolitics have become dominant in the sense that every year we ask the same question, when basically we ask what are the main risks or the main concerning the global economy. No surprise, this year global policies have moved to the top, global geopolitics. And trade war in particular, the risk of a trade war escalation is the top risk for about more than 70% of the respondents. And actually, the next one is a further escalation in military conflicts.
On Trump 2.0, Max, what were the key aspects that were discussed?
We asked several questions, both about domestic implication of the Trump presidency and as well on the international impact. And I would say there are two main takeaways. The first one is that when we ask about whether the MAGA policy, and I mean this in a broad sense, the whole package of tariff, tax cut, immigration, etc., whether this policy will be able to boost the U.S. growth. You might remember Trump talked about a golden age coming in the U.S. Actually, there is a very little trust in that. The majority, nearly 90%, say that it's not going to have a positive impact on the U.S. economy. But what is interesting instead, when we look at the international side, actually the results are a little bit more benign in the sense that they think that all the trade and international alliance, including NATO, are expected to remain in place, although maybe in a different format for sure, in the sense that there is a view that ultimately there will be a negotiation, there will be a deal done between the US and all the trading partners. What is interesting about Trump 2.0 is that when we ask about the MAGA policy, and they say that the MAGA policy will not lead to a substantial increase in US growth, they think that there are more risks which on the way. And let me mention at least three. The top one is the risk of the independence of the Federal Reserve, 65% of the respondents, and this followed by a weakening in the rule of law, and also about the quality of U.S. economic data, which is something sometimes not really mentioned very often in the media, but as you know, there are different measures being taken which would make particularly the government data less transparent than before, which of course is not particularly good. Two final important takeaway. One is about gold. As you know, gold price has been rising strongly over the last few years, and I would say largely on the back of many central banks buying gold. And what is interesting about the view about gold is that while gold is perceived as the best macro and geopolitical hedge, when we ask a question about would you add more gold at this moment, at this stage, actually the majority say no, because they are concerned about potential price eventually coming down. So it might well be that the strong growth in central banks buying gold is behind us. We will see whether the geopolitics will once again fuel these trends.
And Max, let me ask you next about asset allocation.
When we ask whether central banks will continue diversifying, actually we see that there is we reach probably the peak in the diversification trends, particularly when we talk about equity. Central banks have become a little bit, I would say, cautious, but there is still a strong demand for corporate bonds, for emerging market debt, and for green bonds, which is very interesting. Last word has to be on the dollar, the big story of these last few months. As you know, there is a view that the dollar has been damaged by the Trump policy, particularly Liberation Day and what happened after Liberation Day. But nearly 80% of respondents believe that the US dollar will remain the global reserve currency for the foreseeable future, which is very interesting. At the same time, they also expect the dollar to continue weakening. And then there are clear signs of diversifying their US dollar allocation, particularly in fixed income. Who are the winners of this diversification? Top is the euro. Is going to be the main beneficiary, followed by the RMB.
In the fixed income space, you mentioned diversification away from the US dollar. What does that look like, and how's that going to shape the fixed income story?
So what I think when I talk about diversification, I'm not talking at all about a move in big way from the US dollar, but I mean that over the next few years, we expect central banks to continue decreasing the US dollar share, maybe a little bit faster than before Trump because of the damage which has been done after Liberation Day. But as I said, in the foreseeable future, the US dollar is unlikely to be challenged by any other currency.
Now, Shamaila, I want to get your thoughts. Max mentioned the emerging market debt opportunity, which we'll talk about. But just on the dollar, it was funny, we were reflecting before. It's worth bearing in mind, isn't it, that the dollar, it doesn't have to depreciate in a straight line, right? Just as it didn't strengthen in a straight line. That is worth bearing in mind, isn't it, in terms of wider context and understanding of these moves?
Yeah, no, absolutely. I mean, the reality is that the dollar has appreciated over a very long period of time. So the depreciation trend is also likely to be a multi-year trend, but it doesn't have to go in a straight line, as you said, right? There can be periods of dollar appreciation, even though the longer term trend is going to be that the dollar continues to weaken as the diversification that Max is pointing to plays out. So that's something that we keep in mind, but it's really has been interesting over the last few weeks because I attended the conference and met the large number of central banks that attend the conference who were talking about diversifying away from the US dollar denominated securities that are issued by US companies into emerging market investment grade. That really is interesting because the investment grade space in emerging market sovereign and corporate debt has traded actually very much like USIG with respect to volatility over the last 10 years or so. However, it offers an additional pickup over USIG for a sector that is now better rated than USIG. So that's been a theme that Max and I have been discussing with central banks over a period of time. And we've been having conversations now with the dollar depreciation about, adding things like renminbi and other higher rated emerging market local currencies to the mix. But in general, I have seen a big pickup in inquiries from institutions. This is my third week on the road meeting institutions globally as well as clients in the wholesale space, and the interest in emerging market has picked up exponentially in EM indices that are hard currency denominated as well as local currency.
Okay, well, let's interrogate maybe some of the sort of nuts and bolts of this. And you've already alluded to this, but can you just tell me a bit more about, well, why and how then investors look to then follow that diversification path, how, of course, that picks up yield. And I'm really interested in identifying what is it, well, is it the case, and if so, why, that EM now seems to be more resilient in a time of volatility, of crisis, call it what you will, which that does seem to differ from past experience.
Yeah, no, absolutely. We've actually noted that for a number of years, where you have seen the policies in emerging market country, particularly the lower rated ones, improve in a way that I haven't seen in my career, which has spanned, more than 27 years. And that has really led to significant fundamental improvements, which have been reflected first of all, in rating actions, where the upgrade-downgrade ratio in emerging market has significantly improved, with more upgrades than downgrades over the last couple of years. Defaults have been coming down. In fact, there has been no sovereign default in about a year and a half. In emerging markets, corporate defaults have been coming down significantly. So these are the fundamental factors that have been a big factor behind the resilience that you mentioned. But also, I think it's worth talking about trade war, because that has come up as a significant risk. And the interesting thing this time was, first of all, most of emerging market, with the exception of EM Asia, were always at the baseline tariffs even before the pause and discussions on the trade deal. So most of EM was really spared the high reciprocal tariffs, with the exception of EM Asia and the countries in EM Asia who were initially posed the high reciprocal tariffs. They are generally very strong countries from an external perspective and have the ability to use fiscal also if for some reason the trade deals don't work out. And the most important thing that happened was the dollar depreciation versus EM currencies. And the reason why that is so important is because EM central banks now have the ability to reduce rates if US starts to weaken significantly, to maintain growth domestically. And that is something they don't usually have the luxury to do, because generally currencies depreciate, they get worried about inflation, they have to wait for the Fed. So all of these things were really the reasons that they have emerging market assets have been resilient in the recent months. But we've really observed this over the past few years, with emerging market assets outperforming because of the positive fundamentals, more broadly speaking, that I mentioned.
Shamaila, can I just ask you one other quick thing, which I guess is about institutional integrity? I guess it speaks also a little bit to trust. Is it fair to say that, maybe there's not a convergence, but maybe some developed market institutions are, I don't know, sort of, weakening, and they're meeting the EM. It was, that was a weakness of EM, right? Traditionally, was the institutions were perceived to be weaker. Are we seeing a kind of a narrowing of that gap? Is that also another background factor here?
No, you're absolutely right. And there is a perception that emerging market countries are emerging markets because they have higher debt vulnerabilities. And that's not true. If in aggregate, if you look at EM countries, they actually have lower debt on a consistent basis versus developed market countries. So it's really the weakness of institutions that causes EM to be classified as emerging markets. And we have actually started to see that now in developed market as well, with fiscal concerns rising in many of these countries, with a general weakening of institutions more broadly. And that has really led to a convergence in terms of the perception of DM versus EM, where investors are realizing there's a lot of policy uncertainty in developed markets, but at least you get paid for it in emerging markets with respect to higher spreads and yields. So why not diversify geographically and, get benefits of some of what have been improving fundamentals in emerging markets.
A very good example is the fact that in the survey we see about 50% saying that there is a risk to the central bank independence in the US. If you think about the emerging market, from a macroeconomic perspective, you mentioned resilience, which has been going on for a few years now, including during the period of the increase in interest rate in the US. The central bank independence has been a fundamental factor for emerging markets. Actually, they've been probably more reactive than advanced economy central bank. They hike much earlier, and they were able then to lower. And it is a little bit ironic that basically emerging markets took the lesson which the Western countries took the decision of making the central bank independence a fundamental pillar of their macroeconomic framework. And now we have a situation where the leading Western economy, the US, is putting into question the central bank's independence. And this is not just Trump, because actually we had a very nice presentation at the conference from an academic from the US, and who is looking at the central bank independence. And there is an intellectual discussion going on in the US whether the Fed has become too independent and in some way unchecked. And that's something very worrying, because when you open that debate, you don't know how it will end up. In fact, the word financial repression has been mentioned a few times at the conference as a risk faced largely in the Western economy.
Max Castelli, and before that, Shamaila Khan. And that brings us to the end of this edition of The Bulletin with UBS. You can listen again and subscribe to the magazine at monocle.com. You can also discover more and find out how UBS can help you at ubs.com. And it's ubs.com/asset management for more insights and resources from Max, Shamaila and their teams. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.